Have you ever thought about investing in technology? It's a question that's becoming more relevant by the day. We live in an era where technology touches nearly every aspect of our lives. From smartphones that keep us connected to AI systems that predict weather patterns or diagnose diseases, technology is a driving force of the modern world. Consider the ways that technology companies have revolutionized industries. They've transformed how we shop, communicate, work, and play, generating vast wealth in the process. These transformations create numerous investment opportunities for those who are ready to seize them. However, investments should not be made lightly. Diversification, the practice of spreading your investments across various sectors and asset classes, is a tried and true strategy to mitigate risk and potentially enhance returns. Technology investments can play a crucial role in a diversified portfolio, offering a stake in the industry that's shaping our future. Investing in technology can offer exciting prospects, but it requires careful thought and planning. When it comes to investing in technology, you have two primary options: technology stocks and technology index funds. But what's the difference between the two and how do they impact your investment journey? Let's start with technology stocks. These are shares of technology companies that you can buy and sell on the stock market. Think about the giants like Apple or Microsoft, as well as smaller, innovative firms. Investing in individual stocks can be exciting. It offers the potential for high returns, especially if you pick a company that skyrockets in value. However, it's important to remember that with great potential comes greater risk. The technology sector is known for its volatility. A stock that soars today might plummet tomorrow. So, investing in individual technology stocks requires careful research, a keen eye for potential, and a strong stomach for market swings. On the other hand, technology index funds offer a different approach. Instead of buying shares in individual companies, you're buying a slice of the entire technology market. This could include hundreds or even thousands of different stocks, spreading your investment across the sector. The key advantage of this strategy is diversification. By spreading your investment, you reduce the risk associated with any single company underperforming. This can make index funds a more stable, albeit potentially less thrilling investment. However, while the risk is lower, so too is the potential for high returns. You're less likely to hit a home run with an index fund, but you're also less likely to strike out. So, which should you choose? Technology stocks or technology index funds? Well, it's not a one-size-fits-all answer. Your decision should be guided by your risk tolerance and investment goals. If you're willing to take on more risk for potentially higher returns, individual stocks might be the way to go. But if you prefer a more stable, diversified approach, technology index funds could be a better fit. Choosing between technology stocks and technology index funds depends on your risk tolerance and investment goals. If you're considering investing in technology stocks, there are a few key things to keep in mind. First, you need to understand the company's business model. What problem is it solving? How does it make money? These are critical questions that can help determine the potential of a tech stock. Secondly, consider the competitive landscape. Is the company a leader in its field? Or is it a small player in a sea of giants? A company's position in the market can tell you a lot about its chances of success. Thirdly, never ignore the financial health of the company. Look at their revenue growth, profit margins, and debt levels. These financial indicators can paint a picture of the company's stability and growth potential. Lastly, keep up with news and trends in the technology sector. Innovation moves quickly, and staying informed will help you make better investment decisions. Investing in technology stocks can be rewarding, but it requires patience, diligence, and a willingness to learn. If you're more inclined towards technology index funds, here's what you need to consider. First and foremost, look at the fund's track record. This will give you an idea of how it has performed over time, which can be a good indicator of future performance. However, past performance is not a guarantee of future returns, so don't rely solely on this. Next, consider the fund's portfolio composition. What companies does it hold? Are they large, established tech firms or smaller, more speculative ones? A mix of both can offer a balance of stability and growth potential. Another critical factor is the fees associated with the fund. Lower fees generally mean more of your money is working for you, so be sure to compare this aspect among different funds. Remember, the beauty of index funds lies in their diversification and lower volatility compared to individual stocks. Technology index funds can be a great way to gain exposure to the technology sector without the need to pick individual stocks.